If you're an investor, you're going to want to pay close attention to this video because it may be one of the most valuable things you have seen in a very long time. 2025 is gearing up to be a very confusing and challenging year for investors, and I'm going to show you exactly why in this video and walk you through a lot of the economic data points that I have seen that are really quite shocking. I'm going to walk you through some technical things with the stock market and with the bond market, and then we're going to touch deep on crypto and Bitcoin and specifically altcoins as well. Now, what is currently going on? We're going to kind of zoom out, get a feel for where the economy is, and then we're going to start to zoom in into certain asset classes. So the United States is dropping interest rates like many other countries around the world, like Great Britain, we've got Europe, we've got Switzerland, many other countries dropping rates. Now, Japan is doing the inverse. They are increasing rates, which they have not done for 17 years. The last time they did this was right before the 2008 crash. Unemployment is also on an uptrend, and many believe that it's going to continue upwards, but right now it's sitting right around 4%. USA is in 36.2 trillion in debt, which is probably not coming as a surprise to you, but this continuously climbs and at an ever growing rate, especially after the COVID crash where we printed a ton of money, and we're still on a massive uptrend since then. The US is obese as a country because we really consume more than we produce, because our debt to GDP is 123%. Quantitative tightening is not over, which means that the Fed is actually selling assets. So when quantitative easing is happening, what they're doing is they're likely printing money and they're buying assets like treasuries. Right now, they are still selling assets, which they started doing in 2022. So that, if as an investor, kind of is more difficult to invest when they are tightening, because again, there's just consistent sell pressure in the market instead of the Fed actually increasing their balance sheet. M2 is on the rise, so we've got the money supply slowly creeping up after its pullback from 2022 into 2023. It's not a quantum leap like COVID or even the years prior to that, but it is on a slow uptrend right now. There's also massive U.S. Treasury debt coming due in 2025. Many people do not know about this, but there's over $7 trillion in debt that needs to be refinanced in 2025. And actually, Trump saw this before he actually came in, after he got elected. But before he got inaugurated, you can see he's actually comparing now to 1929, which is right before the Great Depression. So he was saying like, hey, pretty much, hey, I'm left with all of this BS, which is the $7 trillion that is coming due this year. That could cause a massive problem, and he thinks that the Democrats are potentially purposely doing that in order to make the markets crash, so that it ends up making Republicans and Trump look really bad. The highest default rates in subprime car loans that we've ever seen, it's at 6.6%. I think this is really important to pay attention to. This is over $1 trillion market here, so it's not a small market. It's not as big as the mortgage market, but it is definitely a very large market that I think could cause some problems in the economy. The Fed is also, this is huge. This just happened in the last really 2 or 3 weeks. Okay, the Fed, specifically the Atlanta Fed, revised their GDP growth rates from positive. Okay, they were positive like right just above 2%, between 2 to 3%, which is where the average is. So that blue section is where the average of the expectations of what GDP would be inside the United States. That has been revised down almost to -3%. So that is huge. One of the Fed banks is saying that, hey, we actually believe that GDP, aka the economic output of the United States, is going to be negative close to 3% instead of 2 to 3%. So this is a huge change that many people have not heard of happening recently. So the summary of current macro landscape inside the United States: Trump tariff wars, which I really didn't even touch on, are really bearish for short term because it creates a lot of uncertainty. It pisses off a lot of other countries. There's arguments to be made that yes, the other countries have tariffs against us and we need now to issue tariffs against them. I'm not trying to make this a political discussion, and honestly, I don't know exactly all of those details. But what I do know is when there's new massive tariffs, like 25% tariffs, that will cause a huge ripple effect in the economy and specifically in financial markets quickly, because it creates a lot of uncertainty, and markets do not like uncertainty. U.S. debt is continually growing, slowing GDP, and potentially even negative GDP, and inflation is sitting right around 3%, which is somewhat close to the target for the Fed of 2%. Japan reversal of interest rates is unwinding a $5 trillion arbitrage trade. So remember, I mentioned Japan is now increasing rates. Why does that matter? What happens is when you have negative rates or very, very low rates, people borrow money, specifically in Japan, they borrow money for free, and then they go take that money and they go invest it in other countries, especially countries that have high interest rates like the United States. So they can borrow at a 0% interest rate, they can make 5% just simply buying treasuries or buying other, assets that maybe even have higher yields. So it's an arbitrage trade. And what happens is when Japan starts to increase their rates, all of the borrowers say, oh no, I just borrowed all of this money. Now I need to start repaying this back because now I'm paying interest. So then they're forced to sell. And that's what I'm talking about, unwinding a $5 trillion trade, which many people, again, don't understand. And that takes time. We're almost, 10 months into Japan deciding to start to increase their rates. Fed is still selling assets. Like I mentioned, quantitative tightening. Unemployment is on the rise. And, if Doge does start to cut a lot of government jobs, there's actually over 20 million different government jobs inside the United States. Not saying they're going to cut the majority or even, close to that. But even if they cut, 1 million, 2 million, that could be a really big deal because you could see unemployment spike up dramatically just from the government cuts. Ukraine and Russian war is still going on, still heating up. The debates between Zelensky and Trump and the White House also created a lot of uncertainty and fear as well. But the one positive thing out of all these is that M2 money supply is on the rise. Now let's go ahead and look at some economic indicators. So overall, investors are starting to go risk off, which this is from cross-border capital, but you can see usually this has ebbs and flows, right? It goes up and then it comes down, and it's kind of like a 10-year cycle. You can see that this is now starting to curve to the downside, which we really have not seen in a while. After COVID and all of the money that got printed, we saw this go up massively, and now it is starting to trend downwards, which may be the reason why we're seeing the beginning stages of the sell-off in the equity market and the altcoin specific market. So other alternative coins to Bitcoin have just absolutely gotten crushed when many people thought that alt season, aka huge appreciation in altcoins, was going to happen. Yield inversion. So this is just how the short-term interest rate behaves with the long-term interest rate. So usually it's the 2-year and the 10-year, but specifically this chart, we're looking at the S&P 500 on the top, and then we're looking at the yield inversion on the bottom. So when the yield inversion inverts and then uninverts, you can see that historically it has predicted a lot of massive sell-offs in the stock market. In 2001 and in 2007, those were over 50% corrections. And then we obviously had the COVID flash crash, which was quite large as well. But you can see that by these arrows at the bottom of your screen, that is the yield inversion. When it dips below and then dips above, historically, it has predicted huge sell-offs in the market and a lot of, and also, recessions. The Fed pivot, a lot of people believe that, the Federal Reserve starting to drop interest rates is great because, that makes debt less expensive. That's going to incentivize more people to borrow more money. And then they're going to spend more money, and that's going to help the economy, and stocks will go up. But oftentimes they are dropping interest rates because there's something really bad going on in the economy. So if you look at these purple triangles, you'll see that a lot of the time, the majority of the time, you see a purple triangle. The S&P 500, that's when the Fed is pivoting on the top. So those are the interest rates on the top. The triangles are where the Fed is actually pivoting, aka changing, pausing rates, and then likely about to drop rates. And then the drawdown, so the amount that the S&P 500 came down on a percentage basis is in the bottom part of the chart, which you can see by these big gray dips here. And you'll see oftentimes before there's a Fed pivot, when the Fed pauses rates and then starts to drop rates, that's where you actually see a huge meltdown in markets, which is exactly what we saw in 2001 and then in 2008 as well. Okay, now that's not exactly 100% correct, and really there's not many things that are 100% accurate. But if we were to overlay, the important part is, because sometimes there is a yield inversion that doesn't yield a big hard landing in the stock market, but it's rare that it does not yield that. But when rates start to drop, that's not always bearish. But what historically has been extremely accurate in predicting a sell-off, which this chart is from Henrik Zeberg, you can see that when the Fed is cutting rates, there's three things that need to happen. The Fed is cutting rates, which is shown in the green rectangle here. Then you've got unemployment starting to tick up. So unemployment also needs to be on a rise. And then you've also got a yield inversion and uninverting, which you can see every time that's happened: 1989, 2000, 2001, 08 and 07 and 08. And then we saw it even happening in the COVID flash crash, where unemployment went through the roof because the whole world was paused. And now we are seeing that. We're actually seeing one of the biggest yield inversions we have ever seen since the Great Depression. And unemployment is on the rise, and the Fed is cutting. So I put this chart together to show four different things, which I think are really, really important that we've already kind of touched on. But this should visually put this in perspective for you. Okay, if we're looking at this is '07 actually, right before the '08 crash. So if you look, there's kind of a dotted line. So there's a dotted line here, there's a dotted line here, here as well, and then here as well. Those are all the same time frames, which is October 29th of 2007. Okay, if we look at what happened there, Japan had their rates, they just increased their interest rates, and it's sitting at 0.5%. Okay, the United States already increased their interest rates, and they were dropping their interest rates down. So they were probably sitting, it looks like they were sitting at like a 4.25% probably interest rate at that time. And then you can also see that unemployment was on the rise. So unemployment came down and it started around, and now it's starting to head up. And it was only at, like 4.5% at that given time. And then at that given time, the reason why I'm talking about October of '07 is because that was the very top of the stock market before it went down 58%. Okay, so let's keep an eye on this. Japan rates 0.5%. They just hiked. United States dropping rates, unemployment ticking up, and the stock market on an uptrend, and then it broke the uptrend, came back and retested that support and then used it as resistance, and then went down 58%. Now let's go ahead and look at where we are at right now. 2025, Japan hiked rates. We're sitting at 0.5%. United States dropped interest rates. We're now on the decline. And unemployment, which I zoomed in a little bit on a shorter kind of time frame, but you can see this is from COVID, how big that was. You can see that we are on an uptrend. We bottomed just above 3%, and now we're sitting at 4.1%. And then the S&P, went on a huge rally and now just broke the support line. And this was in February of this year in 2025. Just broke that about a week ago. Now, one thing that does have a 100% hit rate as far as recessions go is the percent of civilian labor force unemployed 15 weeks and over. And if you look at every time this blue line goes up, we then hit a recession, which is these gray rectangles here. So every time the blue line goes up, recession, up, recession. You can see that happens over and over again. And what is happening right now? We are on an uptrend right now in 2025. Now, the last real recession was 16 years ago. So the average recession happens every 6.5 years. This last one lasted 18 months from '07 to '08 into '09. And I think it ended, sometime early '09. And if you look at how big this red box is, this was a this was a 2-month recession during COVID. And really, it was a synthetic recession, in my opinion, because they just locked down the whole economy. So no kidding, you're going to go into recession if you don't allow anyone to actually open their doors. So really, we have not had a true recession for 16 years, which is a very, very long time. And again, on average, they're happening every 6.5 years. So for us to not really have a real recession for that long of a period of time really just shows me that we're probably long overdue. Stocks are way overvalued relative to commodities. So usually I'll show you on this next chart, the markets go on like a 10 to 20 year move on an uptrend, then they'll go 10 to 20 years sideways. And oftentimes the inverse happens to commodities. So you're going to see these big ebbs and flows where, you see commodities do really well, then you see stocks do really well, then you see commodities do well, then stocks do really well. You can see the tech bubble was, one low on the extreme where stocks were way, way, way overvalued relative to commodities. And then you'll see like at the bottom of the market in 2008, you can see that commodities were worth a lot more than, stocks, because stocks came down so much in '08. And then you can see that today, now we are sitting at a very, very low. I mean, one of actually the lowest low, at least since the '70s. So it's literally almost off the charts on this, and that's just showing you how expensive the equity market is relative to commodities. So this is what I'm speaking about, the 10 to 20 year usually uptrend you get in the equity market, then the sideways price action, then the 10 to 20 years up, sideways price action, 10 to 20 years. And obviously we've been on a very long uptrend since the collapse in '08. So the question is, are stocks rolling over? Well, from a technical perspective, we do have bearish divergence, which is RSI coming down. You can see it has a lower high, and you can see that brought down the market. Right now, we've had a lower high really since March of 2024, and you consistently see the equity market on an uptrend. So a high, higher high, higher high, higher high, and that entire time we are seeing bearish divergence, which is the strength of the asset going down but price going up. It now has broke the uptrend, and now the RSI is confirming below the 50. So if that trend stays down and to the right, that could obviously mean that a bigger sell-off is potentially coming. If you remember what I saw in what I showed you in '08, it was we saw a break of support, then a move higher to retest that support as resistance, and then you saw a breakdown, and then the huge move down after that. So it's not just a straight line that happens. It could take place over the next few months, because it took a few months after the S&P broke the uptrend in '07, '08 for that to actually play out. So another thing I want to show you too is that the bond market has gone through a historic bear market. It's been one of the worst bear markets in bond market history, and it is sitting extremely low. You can see, just look how big that divergence is relative from the stock market relative to TLT, which is one of the most famous bond indexes. You can see just how low bonds are right now relative to the equity market, which usually when you see a sell-off in the equity market, you see bonds rally. That's kind of like the safe haven that people go in and buy. And when investors see that equities are overvalued, they'll go buy bonds because they can get paid, right now practically 5% to just hold on to treasuries. So they're like, hey, get me out of this thing that's overvalued. Let me go buy bonds because at least I can get a nice dividend from that. And you're seeing right now a huge divergence in where the equity market is relative to the bond market. Now, maybe you think, okay, well, Jeff, you're just showing me a bunch of data that because you're bearish and you want the market to go down because you're biased. First of all, I'm not biased. I would prefer for the market to go up. I've got definitely more long positions than short positions. But as it stands right now, which is March 9th, Warren Buffett has $325 billion in cash, which is, if you look at his cash position, by far the highest cash position that he's ever had. So maybe you don't think that this data is correct, or that you think I'm biased for whatever reason. Maybe you should take a look at it, because Warren Buffett is showing a sign that he is becoming very defensive. He's converting a large portion of his portfolio into cash and into treasuries and getting away from equities, which he has been doing since really the second quarter of 2024. He has been scaling up his cash position, and more recently he has taken it to the moon, now sitting at $325 billion in cash. So my personal forecast right now, the U.S. stock market, and by the way, this is all my personal opinion, so don't take this. This is for educational purposes only. This is not a recommendation to buy or sell any asset or security. But this is just based on all the data and the hundreds of hours of research that I do on the economy and on markets. This is my personal forecast. The United States stock market likely just topped or may top over the next few months. I'm putting maybe a date on May of 2025 would potentially be, I think, my longest duration, unless, if it does head higher in May and we see new all-time highs past May, then my forecast would be deemed incorrect, and I would actually probably start to turn bullish. So, this is me again, just giving a date in mind where I think I think it's likely that we already topped in February. But if the equity market does have one more push higher, I think it could happen into this month, March, maybe April, or latest May. And if it goes past May and we start to see new all-time highs in the stock market, I will start to rethink my thought process. The market is going to continue to go risk off throughout 2025, and almost all assets will sell off similar to 2022, but I think it's probably going to be worse. The Fed will drop rates to zero and print a bunch of money and begin quantitative easing by buying assets. Early 2026, at the latest, the bond market will see a huge rally like I showed you, TLT. I think that is so massively suppressed. And if you look at open interest, there is huge open interest, aka leverage, that has likely been holding down TLT in the bond market. And when they start to drop interest rates, typically bonds react the inverse to interest rates. So if interest rates come down, bond prices typically go up. And I do think that will likely happen in early 2026. That's what happened after 2008. You saw at the beginning of the year, you saw TLT in the bond market go bananas after the stock market bottomed. And then as the Fed continues to stimulate the economy in financial markets, commodities like precious metals and crypto will see huge historic rallies. So like I said, the bond market is massively oversold. Likely there's a big rebound potentially coming if they do end up dropping rates and we do start to head into a potential recession. And then like I was saying earlier, commodities are way down relative to equities. So I am projecting that after the big sell-off, bond market goes up pretty quickly. And then we do start to see them print a ton of money. And that printer is going to drive primarily commodities like precious metals and Bitcoin and crypto a lot higher than where we are today. So let's go ahead and jump into crypto and how all of this data kind of impacts that. I'm going to just walk you through the 4-year cycle because the 4-year cycle in Bitcoin could potentially be over. If you understand what the 4-year cycle is, it's just where the Bitcoin cuts its new issuance of BTC in half. That happens just about every 4 years. And every 4 years, we've seen 3 years of bull market, 1 year of a bear market. And it's been very interesting because both previous cycles have topped 518 days after the halving event. So that's what that green box is. After the halving, which is when Bitcoin cuts its new issuance in half, it's been 518 days until that next high. And then we head into a 1-year bear market. So that happened in 2017. That then happened in 2021. And then now, if that were to happen again, 518 days later, we would then see a top of the market, likely around 180 grand, and it would be towards the end of this year in 2025. Now, more recently, we've seen a pretty big sell-off on Bitcoin down to the low 80s, which is just over a 30% correction. And you have seen that, previously in previous bull markets, you do see 30% corrections quite often. If we just look at the 2015 to 2017 bull market, there was 10 new highs, average about 144% on those growth between the low to each high that it ran through that 2017 bull market. There were 9 major dips, average 34% for each dip. And a lot of people are really worried right now because we did just have that first really major sell-off from the $108,000 high to where we're at right now, which is in the low 80s. So this is kind of how I look at the overall, visually look at the Bitcoin bull market. If we are staying above this trend line, I am still, we're in a bull market, okay? If we head below this trend line and we are still sitting above previous all-time highs of about 69K, which happened in late 2021, then if we're sitting below that trend line and above 69K, then I am still bullish for the most part, but I'm getting very defensive and cautious, because if we start to break down below the previous all-time high of 69K, I think it's time to get very defensive and protective. And that doesn't always mean, hey, sell everything and get out, right? That's not always I'm going to be 100% on spot positions, or I'm going to be at 0% spot and 100% cash. That's not how it works. It's usually a sliding scale on at least for me, on a portfolio of scaling up cash and scaling down different spot positions. Are altcoins dead? That has been the big question here. Yes, I think that most of them are. I think a huge reason why the altcoin market has been held down is because we've seen the largest short on Ethereum by far, which is over $10 billion, and has been being held on specifically Ethereum. It really started right around September of 2024. And we've seen this short be held on Ethereum for a very long time on CME, which is if you're in the crypto world, you don't know what CME is. It's a traditional exchange. It's the Chicago Mercantile Exchange, and they are heavily short Ethereum here, which, if you're suppressing the biggest altcoin in the market, it's likely going to impact the rest of the altcoins. Another major reason why we haven't seen altcoins, which I think alt season, is this, which is really, really crazy. In 2020, we had 137,000 tokens. Okay, so total amount of crypto tokens was 137,000 in 2020. In 2025, we now have 39.4 million tokens. 39 million different coins that you can go buy. Okay, so this was a 28,000% increase in just 5 years. And the total amount of new money in crypto only went up 1,500%. So we had a 28,000% increase in the number of coins that you can go buy, but the total amount of money in crypto only went up 1,500%. So what is that percentage difference in growth between the amount of new money and the amount of new tokens actually tell you? Well, it tells you that capital is spread too thin in the altcoin market. Okay, there's not enough new capital to go into the altcoins to cause them to really appreciate. There's a smaller amount of capital, and yes, it is growing, but it's a smaller amount of capital relative to the amount of new tokens. So all that capital is spread too thinly, and people are just chasing these pump and dumps, and most of them are getting wrecked. A few people are probably making a lot of money. The few people that are launching the actual coin and literally getting it for free, and then you're buying it, and then you're getting dumped on, and they're practically stealing your money. So it's a very small group of people that are probably getting rich, like the people that own Pump Fund that allow you to launch a meme coin in 3 seconds. Those people got mega rich. They made like $500 million in Solana. $500 million in like 6 months. It was insane the amount of fees that they made. But there is hope, in my opinion. 2021 bull market also saw a historic crash that then recovered. Okay. Bitcoin dropped 55% in 2021, practically in the middle of the bull market. Ethereum dropped 61%, and then after that went up 186%. When Bitcoin dropped that amount, AVAX went down 85% from its high, and then went up 1,500%. Solana went down 67%, and then went up 1,200%. And Matic went down 78%, and then up 370%. So the question is there going to be an alt season? And I think as time progresses, the probability is getting lower. But if you look historically, alt season in 2021 happened truly in March, where Bitcoin dominance, which is what the chart that we're looking at, which is the total amount of money that Bitcoin has in its market cap, so the total amount of money in BTC, where you'll see that in alt season, that starts to break down. So when that chart starts to break down, that means more money is going into these alternative coins to Bitcoin. And you see a larger percentage of the total crypto market cap get made up from alternative coins to Bitcoin. So all those other altcoins, when you see that chart go down, that means that more money is flowing into all these other projects relative to Bitcoin. we have not seen this chart collapse yet. So if it doesn't happen in March, it's a pretty good sign that, maybe we're not going to have an alt season this year round, because maybe the market's just too risk off, or maybe people are sick and tired of getting rug pulled by all these stupid meme coins. So will the crypto market cap recover this cycle? I believe so, if, and this is the most promising chart right here, which is Raw Powell posts this all the time on X, and it talks about it on YouTube as well. But global M2 is on a continual uptrend right now. We actually did have a correction recently, which then potentially brought down the price of Bitcoin. So if you look, these charts are highly correlated. Global M2, which is the total amount of really money supply in the globe. If you see that black line going up, and then the pink line is Bitcoin. So when black line's going up, which is, it's pulled back 10 weeks. And when you overlay it with a 10-week lag, the M2 has historically kind of front run Bitcoin by about 10 weeks. And you'll see that when that black line goes up, Bitcoin goes up. When the black line goes down, for the most part, Bitcoin is going down. So we'll see if that correlation continues. But right now, the black line is going way up right now. So that could be a sign that we see a pretty strong rally in Bitcoin. And we'll see if it does recover, which it should happen here pretty soon. If not, these two are starting to diverge. So there's two things that can help Bitcoin and the crypto market go up. Obviously, the M2, if this continues up, it's likely going to help Bitcoin and probably altcoins as well. But also, if the stock market doesn't tank. I am watching this super closely, because if the equity market breaks down, then we have a nice little dead cat bounce and it rejects once again and then starts to go down faster, that is a very good sign that the market's going to continue to be risk off, and it's going to be very difficult for crypto to perform. And remember, this isn't just a technical chart. This is overall interest rates in the credit market doing its thing. So, and this isn't, we can't say for certain, oh yeah, it's happening this month or next month. Yes, I gave my overall thoughts, but things can take time sometimes, and especially when you print a ton of money like we did in 2021, it makes things very confusing, and it's difficult to understand, what could potentially, occur. So we'll see if this plays out. If we do see the yield inversion and all the other data points that I talked about start to bring down the market, specifically the stock market, and we continue to see this confirmed below the trend line, and we keep seeing RSI break it down, and it's starting to confirm, especially below the 200-day moving average, we could be in for a deeper bear market, which could take, it could ruin the 4-year cycle for Bitcoin, which is the first time that we've ever seen that happen. So it's going to confuse a lot of people. And if the equity market holds up and M2 continues to rise, I think that could, allow us to continue the crypto bull market and be a little bit more risk on than what we've been, especially recently. So summary of the crypto market: crypto sentiment is in the dumps for all the scam meme coins continually getting launched and taking everyone's money. BTC is likely to continue its move up towards 180K, in my opinion, if liquidity continues and stocks do not dump. I believe alt season is coming, but only for the top few projects that I think are, really primarily the ones inside the 200, 200 by market cap, and that are real projects that are focused on utility. Yes, some of the top blue chip memes could do well, but I think primarily projects in AI or real world assets would do well if the alt season actually does occur, which again, if that doesn't happen in March, then I think the probability of alt season is going way down. So I'm watching what is happening this month in March to altcoins. If we don't see them rallying relative to Bitcoin, or if we see the equity market starting to sell off quicker, that's going to really, it's putting the probability of alt season a lot lower, in my opinion, and that's something I'm watching super closely. And if the stock market, pulls down crypto, the printer's coming either way. Okay, so anytime there's pain in the economy or in the stock market, guess what happens? They print a lot of money, they lower interest rates, and then what drives every asset in the world is liquidity. So when liquidity picks way up, because they have to, because the market sells way off, guess what? Risk assets will go bananas. And that's why I was talking about, if we do see a collapse, even if we do, and it's really bad, you're going to see them print money, lower interest rates, and it's likely going to lead to a lot higher prices, specifically, I think, for commodities, precious metals, crypto, and you'll probably see a really strong equity rebound as well, depending on how low we go. So anyways, thank you so much for watching. If you get value from this type of research, I do run a small community and signals-based program where I talk about, I screen share charts and technical setups. And I take this data and I say, okay, well, how am I going to put this to work? How can I actually benefit from which way I think the market is going based on the research, data, and analytics that I spend hundreds and hundreds of hours studying, because this is what I do as a professional. So if you think you would get value from more data like this and understanding the setups that I personally take, because you think you would get value from that based on what I'm primarily in crypto, FX, and beginning to get into the early stages of using options to hedge the stock market a bit. If you think you get value, there's a link in the description below. Regardless, if you got value, please let me know by hitting the like button, leaving me a comment. I'd love to hear your forecast as well and what you think. And again, if there's someone that you think would get value, whether it's your dad, it's your friend, it's your colleague at work, if there's someone that is heavily invested in markets and they like to understand the data and the education behind what's playing out right now in the market, please share this with them so that they can get value as well. All right. Thank you so much for watching, and I'll see you here on this next video.